Hi, welcome to another edition of WCM's Outdoor Hospitality Update. I'm Ben Quiggle, editor of Woodall's Campground Magazine. My co-host Mike Gast, uh, writer for RVTravel.com, and you do a lot of other freelance writing too, right, Mike?
Oh yeah, anybody wants anything done, just give me a buzz.
Yep, he's ready to write stuff. So, and you put together the Campgrounds of America guide this year, which that's not quite done yet, is it? Or is it off
Yeah,
to the printer?
well, supply chain. We're just waiting for paper, and then that'll go on the press and hopefully be available at the campgrounds in early March.
Yeah, I mean, printing paper is, depending on what you're printing, it can be iffy to get right now. So it's
Hmm.
expensive too. So, and then joining us is Chris Hipple, Vice President of Leavitt Recreation. I guess, Chris, what's the full title there? Leavitt Recreation and
Leavitt
Hospitality?
Recreation and Hospitality
Okay.
Insurance.
Yes. And you've been in the industry for a while. I know, I guess just tell us a little bit about how you got into the industry and how long you've been with Leavitt.
Well, I was working at the family newspaper. My actual degree is journalism, so we got three writers on the call here.
Wow.
And if you've ever worked with your family, you know why I got the heck out of working with my family. And so in 1993, I went to work with Fisher Rounds and Associates, which is a hometown insurance agency based in Pierre, South Dakota. And I did that for 17 years. And then I got approached by Leavitt Group back in 2009 and came over as the lead principal at Leavitt Recreation Hospitality Insurance. And when I started there, we had 11 employees, and now we're at 32 employees. And so we've grown quite a bit over the years. And
Yeah.
I'm coming up on my next year will be my 30th anniversary in the insurance industry. So
Wow. And so your family owned the newspaper?
yeah, for 125 years, the
Wow.
Daily
Cool.
Capital Journal in Pierre, South Dakota. So I did the police report, I did the county commission, the school boards, I did went up to the legislature and got reported on that as well. So I did that for a while, but there was no money in it.
We probably ran into each other before then, because my first job was at the Aberdeen American News in Aberdeen.
Oh,
South
really?
Dakota. So
Okay.
we probably covered the legislature at the same time.
I bet we did.
So were you there the whole 125 years, Chris?
Me personally, no, but my family has been. So my great grandfather actually transported a press out from Pennsylvania and started the newspaper. And then his son, my grandfather, took it over, and then my dad and my uncle. And then when I was working there was upwards of 7 Hipples working in the small hometown paper. So
Wow.
that's kind of part of the reason I got the heck out, because I'm the youngest of that particular generation. And
Yep.
that was interesting conversations with that many family working.
Wow.
Well, I know I worked in a newspaper here newspapers pretty recently before coming to Woodall's. And then, Mike, I'm sure shares the same sentiment. It's kind of painful to see what the newspaper industry is turning into, but miss the small town papers. So they're not what they used to be like. But that's not what we are discussing, I guess, although it is a fascinating topic. But
We can do
I guess
another whole
Another time.
session on that.
we got a really exciting topic, insurance. I mean, it
Woohoo!
just and people get excited to talk about insurance. But
Sometimes they do.
I mean, it's a crazy time for insurance right now. I think you wrote a column for us a month or so ago about
Mhm.
rates, and just kind of maybe start us off with maybe your outlook. What are people, what's the outlook for 2022, I guess, as far as renewing and
My advice is
insurance
every
costs?
park owner should go out there and raise their rates at their campground. Pretty much, we're seeing universally that they're having a high usage. They're getting the bookings, they're getting things in there, and I know this was echoed by Lauren from Prairie Craft. He went over and taught at KOA University. I just talked to him last week, and he was telling me that he was telling everybody that was going to KOAU to go home and raise your rates. We've entered what's called a hard market in the insurance world, and hard market whereas there is less capacity. And there's less capacity to write insurance with the markets, and it's getting more and more difficult to get things written in terms of insurance. So my guys, when I hire somebody new, I tell them, you're trapped between a customer that doesn't want to buy your product and a company that doesn't really want to sell it. And so you've got to sell both directions. Now, what's happened? And so we've been through, in my career, which is almost 30 years, we've been through basically, this is the third hard market cycle. So they don't happen that often. And the first one was after 9/11, and 9/11 got immediately hard right away. And so I was an insurance agent working in a hometown. I had 45% of my customers get canceled after 9/11. Okay. So I had to go out and find a new home for them. The pricing was worse. It was higher. The terms were worse. You're sitting here doing everything, trying to find something for your clients. And what happens if you can execute and get things done at that point in time, you're able to grow. And I think we're going to be able to grow through this period of time because we're going to be offering solutions that not many other agents are going to be able to find, because this is predominantly our bread and butter. Now, if you're a local hometown agent and you write 5 or 6 RV parks, you're not going to know where to go when those cancellations or those rate increases come. But to go back to the overarching what's causing this. So 9/11 happened, and what caused the cancellations back then was predominantly fear. So the insurance companies didn't know whether we were going to have an attack every week. And they were scared to death. And so they went back to their core business model, jettisoned everything else. And so there was a ton of opportunities out there for people to quote. And when that happens, when you get more in your inbox than you can handle, you're going to start raising your rates to get the prices that you figure you need, because, supply and demand. So then again, after 2008, when the market tanked, we had another hard market. Now, that didn't really impact our agency so much, but it really impacted the construction industry. It really impacted the trucking industry. It really impacted the oil industry and insurance, generally speaking, as a whole. And again, that was fear mostly driven, fear and capacity. So insurance companies make money by underwriting profitable business. They also make money on the spread, which is the time between when you pay your premium and they have to pay a claim. And they also make money on investments. Okay, well, if you remember 2008 and you look at a graph, it just crashed. And so they weren't making any investment income. And so they had to go out and try and raise money, and make sure they're profitable in order so that they can stay in business and survive that market. Now, what's happened in 2019 is we needed rate. We needed rate because claims were trending upward. And I can get into the claims issues of why they're trending upward a little later. We'll just kind of go over the global, and then we can drill down into whatever you want to see. But 2019, we needed rate. So they were planning on getting rate in 2020. Well, what happened in 2020? By March, we had COVID hitting. By May, we had state legislatures oftentimes telling people they had to give money, or insurance companies had to give money back at a very minimum. Some people were reducing their expectations for gross receipts, which is what general liability premiums are based on, or they were trimming back on operations because they were scared they weren't going to have anybody come and stay at their park. Now, for most jurisdictions, most places had a dramatic increase. South Dakota had a dramatic increase in user days at the parks, which was not expected. But if you go to some places in California, they were pretty much shut down. Pennsylvania was shut down. New York was shut down. And Alaska was hosed because you couldn't get there. Okay. There were no cruise ships going up there. You couldn't drive the Continental Highway unless you were a resident. And if you're a resident, you're not going to stay at an RV park. And so their business just cratered during that period of time. So we were trimming everything we could to try and save them money so that they could stay in business. But the core thing, so in 2019, that we went to 20 and we couldn't get rate. We couldn't get it. Okay. So that pushed the problem forward one more year, and the claims still kept happening. And if you remember, we had a pretty active fire season in California in 2020. Okay. So what happened then was the fires burned what they were burning, and claims came in, and the liability claims came in, and anybody who thought that they had a liability claim was looking at this and going, oh boy, I made my millions. Okay. And unfortunately, this coincided with the jury pool changing and getting a lot of millennials into the jury pool, and millennials tend to award more in terms of liability claims. And so what happened was the claims took a dramatic drive up. Meanwhile, premiums stayed flat or went down slightly. And so we pushed this problem off through 2020 to 21. and we saw the results that were coming through. And what happened in 21 was, okay, so nationally there's about I'll say 5 carriers that focus aggressively on RV parks and campgrounds, okay, nationally. And we lost one in July of 21. Now, this isn't the first one. My partner and I have gone back and we came up with 15 carriers that have come in the market, gotten claimed to death, and gotten out of the market. And so it's a constant rotation. And we lost one in July of 2020, and that was due to loss ratio. Okay, so they found a replacement carrier for that book of business, but the replacement carrier came in, and number one, they're canceling all the unprofitable business, and number two, they're going in there and they're raising the rates. My guess is 200% or more on that particular book of business.
Wow.
Now, we didn't only had like 7% of our book of business with that particular carrier, so it wasn't an earth-shattering event for us. But what happened then was, Philadelphia's loss ratio caught up to them, and it wasn't as bad as the other carrier, but they had to take significant action in order to remain profitable. If they don't remain profitable, they're going to be out of the market. Now, a lot of people I've heard the rumor going around, Philadelphia's done writing RV parks and campgrounds. No, they're not. Okay. We personally do $18 million of business with them. And we have a bunch of cancellations. We have probably $2 million in cancellations that we're going to have to find a new home for. We have another 5 million that's going to a different carrier inside the group. So many insurance companies will have 1, 2, 3, 4, 5 insurance companies under their umbrella. And that's so they can have different rate structures. Okay. So we're having to move some of these clients to a different carrier for rate structure. Now, what's driving the claims was on both the property and liability sides of the thing. So property was driving it. We had fire seasons in Washington. We had bad fires in Oregon. We had bad fires in Colorado. We had not so much Colorado, California, and then in Idaho. And so what happened was the insurance companies also buy insurance. It's called reinsurance. And the brush fire reinsurance in certain states went up as high as 70%. Well, all those costs are going to get passed along in addition to the rate increase that they need to get, and along with, the increased operational costs. So as you have inflation in your normal operations, so due to insurance companies, and so due to the claims. Yeah. The claims get bigger. So if you burn a house down 5 years ago, it costs less to rebuild than it does now. So all this activity has happened. And so now you got people from the one carrier we lost in July. We got people that are getting canceled from Philadelphia. We got other carriers taking rate. So clients are out there looking around. And what that means is every other insurance company has a flood of submissions. Well, they read the trade journals. The trade journals say that in 2021, rate increases globally were 20%. Okay. And so if that's what's happened in the market, they can read the trade journal and they're going to take at least 20% just to stay even with because it's available, because they can. If all your neighbors take a rate increase on your RV sites, you're probably going to take a rate increase as well because you can, and you need to get it when you can. So we have a flood of submissions. We have, the insurance companies are able to pick and choose what they want to write and not want to write. And it's a challenging time. Again, our agency, this is predominantly what we do. We know every market that's out there writing this. We know where to go. We know what to do. So if we have somebody that's got a massive claim problem or something like this, we know where we can go and find a home for them and be able to place the business. If you're talking to a local hometown agent, they may not know where to go or have a good idea on that. And so we're seeing a lot of movement. My phone rings with people wanting quotes. Usually speaking, when we go to the trade shows, and this, Ben, and I've talked about this in the past, people are walking down and they're looking over here at the cabins. They're looking over here at the amenity. We can buy this for the park. And then they see insurance and they do this and they walk to the other side of the aisle and try not to make eye contact with us. Now they're calling us daily because, there's a problem out there in the marketplace and they're trying to look for a solution.
So, Chris, is
Philly
this
is not
really
out
a
on the market. Philadelphia is not out on the market. They're still writing campground insurance. They're taking some drastic actions in certain areas to become profitable, and you need them to be profitable because we need that market.
Chris? Is this really a Western problem? Is this something that the fires cause, or is the fallout spread across the entire country?
There's profitable states and non-profitable states. So if is it a Western problem? That's driven a lot of it. We have certain states that are getting the worst of the rate increases. They're getting the worst of the cancellations. If you're in a box canyon that's full of trees and there's really only one road in and one road out, you're probably going to have a much harder time than if you're out in the prairie of South Dakota and you got 34 sites. So the average rate increase is probably going to be around 15%. And that's going to be weighted heavier in the Western states, the coastal states, Florida, places like that, California, rather than say South Dakota. So South Dakota, you might get an 8-9% rate increase. You blend it all out, and it's going to be bigger than that in certain areas.
And we've got a lot of new players in the campground market now. We've got a lot of investment money coming in. Some folks that really don't know the industry that well. Do you find yourself more in an education mode for those new owners that come in that have no background in camping?
Yes. And so we typically try and come across and do a 3-ring binder approach to them. So we kind of give them a franchise answer when they're not a franchise, because we're telling them what you need to do in order to get insurance today. And so one of the things is when you hire a manager, or if you can keep the management team on, that's number one, if it's a good management team. Number two, if you're going to hire management, make sure you get at least 5 years of experience on your manager. And that's so that we can actually go out and get insurance. Brand spanking new owners, if they don't have any education at all, they don't have any prior hospitality experience, those are hard to write. Most of the carriers out there have exclusions on wanting to write those. So from an underwriting appetite standpoint.
And I think you can kind of see that a little bit with Arvik, because I know their national management school's coming up, and I believe there are more investors or developers that attend that. They don't even own a park, but they're going to something like that to get kind of the experience and the certification and get involved in the industry.
Yep.
So I imagine that's kind of what you're talking about, right?
Well, you were at Arvik last year, and I was at
Yeah.
Arvik last year, and we had a ton of people coming up
Oh yeah.
and wanting to just throw money at the industry, and so there was a lot of hedge fund people, there was a lot of private equity companies and people coming up, and they were talking to, heck, I even had somebody offer to turn around and help us buy ourselves out from the Leavitt Group. And I was thinking to myself, what are you gonna, I have this whole back office suite of support, and you're gonna buy that out, and suddenly I have no support at all. And that's exactly the same way it is. So we see people coming from mini storage, we see people coming from hedge funds, we see people coming from this, and we've also seen the claims. So we've seen some of these purchases happen, and then all because of mismanagement or not as good a management as there was in the past, the claims spike. And so the new people, and it doesn't matter whether it's I run out and buy a campground or whether a hedge fund buys a campground, the lessons you learn in those first 2-3 years are the lessons you learn, and it's the expensive education. And the thing is the carriers know this, and so that's why they want experienced players in there.
Does that add value to a franchise like KOA or like Yogi? So it's easy for you to get insurance with a new owner if they have a part of the franchise.
It's just because you're a member of the franchise doesn't mean you know what you're doing. And so you can still make mistakes. Going to KOAU is going to be valuable. Going to the Arvik education is going to be valuable. But from the carrier standpoint, they ask a question: do you have 3 years prior experience in this field? If the answer is no, it's still no. And I'm still struggling trying to get that done. So if you're buying something, keep the management on, or if you're buying one from a private sale, my advice would be at least for a year, have that former owner on call as a person that you can use as a resource, because then I can at least say we're keeping some of the management team on.
Do you see owners cutting corners, not quite covering their replacement costs, things like that, trying to lessen their premiums?
Well, Yes and no. I mean, our clients, we talk to them, and if somebody wants to cut corners, I'd rather have them just cut the building completely out of the policy rather than try and do substandard coverage, because the
Yeah.
policy, oh, there's my dog in the background. The policies, the policies themselves have penalties for that. So you're gonna pay for it on the front end or the back end. So you either pay in higher premium or you pay and not getting as much on your claim through a mechanism called coinsurance. But the property value, so we just had one that their price basically tripled, went from about 50,000 to 150,000. So we're picking off buildings that they're just not going to insure. We're picking off coverages that they're not going to insure, and we're taking their core mission critical stuff that, you know, is six-figure property and insuring the heck out of that. So we're doing that we're doing it as thoughtfully as we can and picking and choosing. But just taking a building that costs $200,000 and insuring it for $100,000, that's not a good solution. You end up eating about $20,000 when claim time comes and takes the roof out. You know,
I think some of the things you mentioned, I know you've written a couple articles for us over the last year, and one of the things you really mentioned is the employee coverage. I think some of the stuff you say about that is just fascinating, about how park owners, yeah, I mean, they just avoid trying to cover some of these employees. I mean, I
well,
think
they
that's a
don't have
shortcut.
employees. They don't
Yeah,
have.
or they don't have employees.
We have independent contractors. And the thing is that every individual state looks at that differently. Texas is the only one where you truly don't have to carry workers' compensation.
Yeah.
But, okay, so let's just take Texas. You're in Texas. You don't have to carry work comp. But they say in the law, you're responsible for any medical bills for anybody that's working for you, and you're responsible for any disability bills. Now, to me, that sounds like they just handed you a coil of rope and asked you to fashion your own noose, you know, and that's the best state. There, you know, Illinois, up to 3 years in prison. You know, California, 1 year in prison, $200,000 fine, I think, 200 or 100. But the thing is the best state still says you're responsible. And so, you know, I had one guy argue with me and on this point, and I said, okay, fine. So he hired a contractor to re-roof a building, and the guy fell off on day one and hurt himself. And it cost my client $25,000 in medical, and he got off light in order to handle that. And the thing about it is, in workers' compensation, especially when you look at that, in most states, you get tort liability immunity, meaning you can't be sued if somebody collects under the work comp. There's never a time you get immunity. And it's so if you can get that for the cost of a work comp policy, and understand our average work comp policy for an average small park is picking up some work campers and maybe one manager. It's about $2,000 a year. It's not even worth messing around with in my mind.
Yeah, I mean, you know, and I know we've spoken about the building values, you know, especially in like wildfire areas. You know, when we Mike, when we spoke with the guy with the California KOA out there, I can't remember his name all of a sudden. Um, I can't remember his name, but anyways, his park was destroyed by fire, and he had mentioned that, you know, he had some building issues with the insurance, but that's so critical too.
Well,
And
not everything that's a personal client of mine, and not everything is covered ever. Okay. And so
yeah,
you're always going to have things that are not covered. Now, he came out of that claim, I think, reasonably happy,
yeah,
because there was buildings that he did not insure and things that he did not. And everybody
yeah,
gets to make that choice. You
yep,
know, we didn't get in a lawsuit because of it. And we worked as hard as we could for him, getting coverage, you know, that we could, and pay out as best we can. Total losses are one of these things, is you're almost guaranteed to have expenses that are just not automatically going to be covered by the insurance company. So for example, in California, they put a rule on there that said every building had to have a hazmat mitigation come out and mitigate that. Well, that was never contemplated in the replacement cost. Okay.
yeah,
And so that expense was going to be borne by the insured one way or another, regardless of anything else. And well, take 2020, for example. Let's say we build a building in 2019, and it costs us exactly $100,000 to build. The three of us got together and built this building. We know down to the penny what it cost. Now, what was that value replacement cost that building in 2020?
Yeah, it varied.
It
So
varied. It varied because 2x4s were as high as $15 and as low in 2020, and they dropped back down to like $7. Now they're going for about $3 again if you can get them. But the thing
yeah.
is the value varied so widely across that 1 year that it just highlighted the point that there's really no way you can, because you're predicting the future. What's the future value of this building going to run? So we try and tell people, insure them. Like for me on my personal house, I insure it for as much as the insurance company will allow me to insure it for, you know, and I'm constantly pushing that. I did a remodel. I went in and raised it again, because at the end of the day, I don't want to under insurance, especially on my home, to limit me on something that I don't know what it's going to cost tomorrow to get. I started a remodeling project back in February of 2021. I still don't have a new fridge. It's a year later. I don't
Yeah.
have this fridge has been on order forever and it keeps pushed back. So
So, Chris, are there things that campgrounds are doing out there that they're being pushed by the competitive market to add amenities that could add risk, and it's kind of a controllable risk? You make a decision to do that, but obviously those things have to be, whether it's zip lines, ropes courses, massive swimming pools, you name it. They're out there, all sorts of things going on out there,
right.
bicycle rentals. I mean, how do you advise a campground owner who just feels like the need, in order to stay competitive, he's got to add these amenities?
Right.
Mhm.
So there's some amenities that push you. So if we say there's 5 carriers nationally who will insure this stuff, there's less that'll insure the fun amenities. Okay. And if there's less carriers insuring the fun amenities, the price is going to go up commensurately. And it's going to be more and more challenging to write those. So for example, the yogis are way more challenging to write than a standard, let's say a KOA travel, because that's not a destination. It's not an adventure. It's one that where people going through from point A to B. Point B don't have a lot of amenities. Those are a piece of cake to write. The challenging ones, in my rule of thumb, which I've used for years, is anything a 13-year-old boy would find fun to do more than once is going to cost you money. And you need to contemplate that and really determine, because if you're talking about free amenities, whether it's a jumping pad or a climbing wall or a ropes course, or even now a slide, anything bigger than like an 8-foot little kiddie slide is pushing you out of appetite for insurance companies and needs to be considered, very closely, because what does it do to your ROI? And that's the question you need to ask, which is a market determination that you need to make on your own park. But the thing is I guarantee you the fun stuff will raise your price and limit the companies that will quote it.
Yeah. I mean, I was just reading about, I think we had a story up yesterday about a park that was adding a water park. And what, do you see a lot of park owners that come and have these amenity discussions with you before they add the amenity, or do you see a lot of them add the amenity and then have that discussion?
It used to be about 50-50. If you got a good relationship with them, like I've got my A-list clients, I've got a pretty good relationship with them, and they'll call me and talk to me. But some people just add stuff and they don't even think about it. And the worst one is the guy who decides to build it himself. So we had one that was building his own zip line. And it's like, well, you're going to get canceled and you're going to move to surplus lines if we can find you coverage. Or buying the Zorball, for example, that's an immediate no-go. But if you're talking about water amenities, the giant flotation things with the obstacle courses and things like that on them, or you're talking about a true water park, you cease to become an RV park and you become a water park. So if you do all that, that's fine and dandy, and we'll try and find you a market for it. But you're going to be going to the water park insurance companies and you're going to get lumped in there rather than getting in an RV park. So for example, if you've got a gas station that does $2 million in receipts and you've got an RV park out back and that does, 50,000 in receipts, you're not an RV park. You're a gas station with an RV park in the back.
Yeah.
And that you got to look at what's really driving the exposure. So like I said, anything elevated, anything, and the inflatables, because the inflatables drive claims. Like even the little blow up slides you can get at Sam's Club, those kinds of things will get either a cancellation or exclusion on them today. We had one guy get one of those just going into his pool, and he had to buy a separate policy, and it cost him $5,000 just for that policy for that inflatable.
I know you talked about Philadelphia already a little bit, but that's a common theme I hear when I go to conferences. Is there's a lot of owners that are really nervous about there coming a day where there's just not going to be any insurance available, or there aren't going to be any carriers. I guess, what's your perspective on that? Looking down the road, I guess, is that a real concern? I mean, if the fires and natural disasters keep up and things like that, I guess.
Well, what's controllable and what's not? So first of all, is there enough business out here to maintain the ability to get insurance? And I think the answer is yes. So you want the big carriers to be in the market space, even if they have limitations and exclusions and what the price is. And as far as the price, it's just like the electricity price goes up. You're going to have to make adjustments in order to handle that, because at the end of the day, insurance is many people pay premiums so that a few can have claims. Okay. And if the claims skyrocket out of control, then what's going to happen is the prices on everybody, the many, is going to go up in order to handle that. And if there's certain jurisdictions that it's worse in, you got to expect that it's going to be worse in terms of pricing. So on average, I used to say that pricing for a park in California was triple what in the Midwest was, But the thing is they also have triple the capacity. They are open 12 months out for the most part, except Northern California. But, the Southern California stuff, they're open 12 months out of the year. They have way more population to draw from. They're going to get a lot more play usually than, say, a park in South Dakota would. But I think that the forecast is good. I told you earlier that we had seen 15 carriers enter and exit, but there's always been certain players that have been in there and been able to stay profitable. Now, the good news is that there is a big agency like us that serves this industry. And the reason why is if Philadelphia got out of the market, I have enough zeros of business in that I can pick up the phone and make a call and get a company interested in writing this. Again, if you're doing business with a local guy, that's great and fine as long as the market's good. But if Philly decides to get out of the business and he calls somebody else and says, hey, I got 10 parks insured, what do you got for me? You have to have $10 million of business in order to get a program these days. And we have two programs right now. We have a work comp program and we have a property casualty program with Allianz.
Okay.
So we've got a lot of new construction going on. I've never seen anything like it in my 20 years in the RV business and campground business. What does that do to the insurance part? Is it all these new parks? Is that going to exacerbate the problem you're seeing, or is it going to, since they're brand new and all nice and shiny, is that likely not to have a claim?
Well, they're not going to have probably the same claims. If you look at the new parks and you go into them, they're really nice. Everything's groomed to within an inch of its life, and then you go to some of the parks that have been around since the 50s and 60s, and it's a completely different vibe. It's truly kind of being in the wilderness, and so a lot of the new parks that are going in are like world-class resorts. And so are they going to have less claims per 1,000 people that go through in there? Probably. And they're all going to be ADA compliant, and they're all going to have, perfect walkways and all this stuff. And they're going to have a maintenance staff, and they're going to have things like that. Whereas the old park, it was Ma and Pa running the show, and if you go to Arvik, you see Ma and Pa, they're in their 60s or 70s. And the deferred maintenance starts to happen, and things like, I'll get to that next year, or I'll work on this next year, or whatever. So are the new ones gonna help? I think they probably will. And the thing is, everything costs so doggone much right now that you're not building a 50-spot RV park. You're building a big property, and typically speaking, big properties, like you take a hotel in Vegas, a big hotel in Vegas, has less problems per 1,000 people that go through the door than maybe a Comfort Inn and Suites does.
Yeah. I guess just real quickly too, I wanted to talk a little bit about the cyber, because you've spoken to me before about cybersecurity and
Mhm.
how, is that becoming a bigger factor for the campgrounds? What's the claims
For
look like?
everyone, and it's not covered in your base package. For everyone, it's becoming a bigger concern. Getting these links. Hey, click this link. I saw something for you, or what have you, and you click it, and suddenly your entire operation is compromised. The concern there is a couplefold. So number one, everybody's using a third party processor of their credit cards and all the PPI that's gathered. Well, the laws say that if you collect that data, not if you retain it, you collect it. So you're getting that card and collecting it. You're responsible for notification and tracking on their credit report. And that costs about $225 per person. So if you got 1,000 clients, that's $225,000. I mean, the number gets big in a hurry. And that's not saying anybody got lost money or anything else like this. You just had a breach. They caught it and they controlled it. Now you got to do the monitoring and the credit reporting, And so the number gets huge in a hurry. And the thing is most of the third-party vendors, I believe, I haven't looked at their contracts, but I'm guessing that they pass that liability by contract onto the client, and the client doesn't even know it. And so the issue is they've got an exposure. And then secondly, if you look at the exposure that's out there, we've had certain places get their website hacked and then had to buy it back from the hacker in order to get access to it. We've seen that, I think, 2 or 3 times. Cyber is not as big a concern for me as having work comp. Cyber is not as big a concern for me as having coverage that gives coverage for ADA compliance issues and discrimination issues, because somebody actively has to do something to take your thing, or you have to be dumb enough to click on a link. And some of those things are a little bit controllable, but it's out there, and you got to be aware of it.
Well, people can send like cute cat pictures, and that's enough for me to click on a link. So, uh, but I would imagine, maybe that gets a little bit more involved as, there's still quite a few parks out there that are still pretty low tech. So maybe with the newer investors and developers coming on that are more high tech, and then as the mom and pops transfer over more,
Well, and they're
maybe,
bigger and have more money. So they're going to target people that have money. Otherwise, they're going to have
yeah,
to lower their asks. So if you hack a city like they did, I heard about one that got hacked and they had to pay, $125,000 in Bitcoin or something like that to the hackers. So they released their stuff. And generally speaking, from what I understand from my friends in the security industry, most of them do release it, because there has to be that expectation out there. Otherwise, nobody would ever pay. But from what I've heard on the small scale things, the ask is generally lower, $5,000, $10,000, something like that. But, if you don't have any coverage for that, you don't have any coverage for it. And you just need to be aware of that and be really careful.
So, Chris, is there still room for the mom and pop operations in the camping business, or is the insurance costs just another way to drive them out?
No, I just renewed a policy here today that was, what state was it in? It was in Arizona, and I think it was $3,500 a premium. If you can't afford $3,500, your business model is pretty tight. And so I've written parks with as few as 4 sites. That's not really a park. That's some farmhouse that put up 4 sites. But the rating basis is either on the number of sites or it's on gross receipts. So they're not being squeezed out by the insurance costs. If you expand, or if you have too much property for the revenue that you're driving, let's say we go out and build a park, the 3 of us, and it's in the absolute worst place we could think of, like North Dakota.
My home state.
Yeah, well, but there's not a lot of camping going on in North Dakota.
No.
And so if it's in North Dakota and we put in, $4 million worth of property there, and we're doing 150,000 in revenue, your expenses are going to get out of line in relationship to your what you're revenue driven is. So that's again looking at when you talk about investment versus opportunity. You got to do that. You got to do your SWOT analysis. You got to do an ROI analysis, and you got to see what you legitimately think you can drive in terms of business. So I've had many clients who typically it starts off as a rich person who puts all this property in a big, huge lodge and all these cabins and stuff like this. Well, and then they either die or they sell it or whatever, and somebody comes in and buys it for a song, or at least they used to. Now they can't, but they used to be able to buy it for fairly decent amount of money. Well, now their insurance cost is $35,000, $40,000 or whatever it is, and they have no business model for it. They have no, because the former owner didn't care. He was a multimillionaire, So you run into those situations sometimes where your property rate outdrives your ability to earn income.
Yeah. So I it's just all smart business decisions, I guess. So
you can still do a small one. You can still build a small one today, and because we have those people. We have those people calling us on all the time, and I go in there. So my standard response is so Mike calls me and says, "Hey, I'm building a park in Ohio." I'm like, "Okay, where are you building? What are you doing?" "Oh, it's just gonna be a little park." "Okay, so you're gonna have an office that's gonna be $300,000 to build that office. You're gonna have 2 bathhouses. Those are each gonna be $60,000. You're gonna start off low and you're gonna build up to say 300,000 in revenue. You're gonna have a maintenance building over here. You're gonna park your 0-turn mowers in it, stuff like that. That's going to cost you $5,500, And generally speaking, I'm pretty accurate about those things, and that's just from history. But and of course, pricing's going up. And then if Mike goes and adds some, the bungee jumping wall, then all of a sudden I got to pull out the rest of my hair and start working on my beard.
So Chris, are you ever going to open up your own park? You know a lot.
You know what? I'm getting to an age where I'm starting to see the end of the rainbow. I'm not looking for another job to do. I might come and work for somebody at a park mowing lawns. That sounds, put a set of headphones on and just kind of go around in a circle and mow lawns. But, I've got enough to chew on with 32 employees, and we're still growing and still looking at doing things. And I'm not done here yet. So probably not. I do have a couple rental properties so these things are on my mind a regular basis right now. But
yeah, it's not so much that he knows a lot, Ben. It's because he knows too much, and I've kind of been there with him. And I got tons of respect for the folks that run these places, and I talked to a lot of them during the year, still working with KOA and the directory, and it's become an all-consuming thing. And my last question, Chris, is the fact that campgrounds now are full 7 days a week. That there's several campgrounds out there that used to be able to let the staff go Tuesday, Wednesday, Thursdays, and come back for the weekends, and that was when they cut the grass and got everything all up to snuff. Now they don't have that time anymore. They're 7 days a week, full bore. Does that impact their insurance too?
Of course it does. It doesn't impact directly. It's going to impact it in terms of the revenues are going to be up if they're rated on revenues. If they're rated on site count, not so much. But what's it going to impact? It's what happens when you're full to the brim and you're just running around with your hair on fire all the time, is that you don't get a chance to do the maintenance. You don't get a chance to go around and see everybody like you did because your life was a little more sedate. I just was on a call not too long ago where they were saying if we're run 100%, we're going to raise prices and push it back down to 70%. Because one of my biggest clients told me a long time ago, and this was kind of an exaggeration for effect, but he said, if you double your prices and get half the clients, you make more money. And you have less wear and tear on there. You have less utilities. You have less cost, and things. And he was speaking specifically to his business, but I'd never really contemplated that before. But it's true. If you're running around at 100% occupancy, you're almost obligated to yourself, because what are you going to do next year? So you're almost obligated to raise your pricing enough to get to where that starts to trim down a little bit.
Yeah.
Or at least then if you stay at 100%, you can afford to hire more help.
Definitely. And that's definitely conversations we've had with park owners. And I know a lot of reservation providers have had those conversations with owners too. So
Well, the thing is most of the park owners don't camp. At least most of the ones I know, and so the hard part is if you're not a customer, you don't really know what the rate should be other than just surveying your local rate. And so I remember when, this is going to date me. I remember when Suburbans came out and they were $20,000. And I thought, oh my God, no one's ever going to buy one of those. They're so expensive. And now a $100,000 normal daily driver car is not unheard of. And so the thing is the inflation sometimes grows past us old guys' ability to adjust mentally to it. And so having a recalibration of your brain sometimes, it's like the replacement cost on buildings. I talk to people and they're like, oh, I could rebuild that for $80 a foot. And I'm like, I just did a deck and it cost me $40 a foot. Really? You can rebuild this building for $80 a foot. I took one guy from $40 a foot to $250 a foot on his replacement cost. And the guy was an architect, he should have known better.
Yeah.
But never thought about it.
Yep. And we're right now with the way inflation's going, I think it's all blowing our minds. So hopefully they can slow it down.
Well, and if the economy turns around and starts heading the other direction, if it starts going down, things are going to get real interesting in a big hurry. So then again, goes back talking insurance. If they're not making money on their investments, they got to make money on the underwriting. And if the market turns hard enough, interest rates come up, prices, valuations go down, that's going to impact all of our clients.
Yep. Well, I think that's about all the time we have for this week. So, Chris, it was great getting to talk with you again. I know I saw you at Arvik last, I believe. I think I saw Damien at KOA.
Yep.
I don't know if you were at KOA. But,
no, we divide those up. There's too many of us now.
You mean you don't go to every single conference?
Yeah, I want to be gone all the time. No, this was a lot of fun, though. You guys, anytime you want to get me back and talk about anything, I'd be happy to come on.
Thanks, Chris.
Thank you for coming on, and it was nice to see you, Mike. Have fun on the beach, and I'm going to try to dig myself out of snow tomorrow. We're supposed to get like 10 to 20 inches here in Michigan. So
I'll think about you for about 5 seconds.
All right. Well, thank you, everyone. Thanks for watching, and everyone have a great rest of the week.
Thanks. Bye.